the IPO has been successfully, over, the money should go to the issuer. Okay. Now we talk about the price of the main. This is going to be the one of the last topics of the day. The company issuing shares, called the issuer, can decide the share price in two ways. So this is the most important one because you have to, whenever there is an IPO, the price is given and you have to decide whether you should go and apply for an IPO or not, whether the price is really worth it or not. Okay. So how the company decides about the price? Now the price is always decided with the help of the merchant bankers. So whenever the company has to decide, it will take the guidance of the merchant bankers. So first is with the help of lead managers, experts who guide the process. So one of the main job of the merchant banker is to assist the company in deciding about the price of the issue. Second is through the book building process, a process where the investors bid for shares, helping to determine the final price. So there are two ways. One is the lead managers. The second also, book building, the price band will be decided by generally with the help of the lead managers. Even in case of the book building, the the price band is determined in consultation with the merchant bankers. Okay. Okay. Just read this.
Price and price band. What can be mentioned in documents? In a fixed price issue, the exact price can be mentioned in the offer document.
Hold on. Hold on. Now, the first is a fixed price issue. Now, Akriti, tell me when a company is allowed to issue share at a fixed price instead of going for a book build. Under what circumstances? When the company has met all the financial criteria. That means it has the necessary net worth, it has been making an operating profit of 15 crores, it has, a kind of a net tangible assets. So all that, the criteria which we discussed, if the company has met all and company has been profitable in past, then the company can go for a fixed price issue. That means the company doesn't have to offer the shares through a book build mechanism. It can fix the price and straight away mention that price in the offer document. Is this clear? Abdul, you wanted to say something? हाँ, absolutely, absolutely. So company, जो company ने financial criteria meet out कर लिया, company is profitable, then the company has a choice, either to fix the price and say this is the price at which we are going to issue the shares, or they can even choose a book build mechanism. Okay, it is a discretion of the company to either go for a fixed price issue or a book build issue if the company is profitable. But if the company doesn't have a profitable past, it doesn't have a net tangible assets, or it doesn't have all that criteria which we discussed, then they have to go for a book build mechanism. Read this now in case of book build issue.
In a book build issue, a minimum price called floor price or a range called price band is mentioned in the red heading prospectus, a draft version of the final document.
Hold on. So that means, if it is a book built issue, then a price band has to be calculated. The floor price, there is a range, the price band needs to be the cap and the floor price. Both will be mentioned. Okay. And then the document will be called red herring prospectus. Okay. So, okay, read further.
Final price is decided before filing the final prospectus with the registrar of companies, and this final document must mention only one final price.
So once the company book build issue mechanism has been complete, company has received all the applications, company has decided the cutoff price, that means that price at which they are going to issue the shares, finally, then the share price is determined and the company is supposed to file a prospectus, a final prospectus. Okay, it is basically the final version of the red herring prospectus, and this final prospectus needs to be filed with registrar of companies, which will mention only one price. Okay, read this.
Limits on the price band. The maximum price cap in the price band can be no more than 120% of the floor price.
Suppose the price is say 1,000, so 1,200 would be the maximum price. Okay, so this is the maximum band. Okay.
Minimum price condition. The final price and floor price cannot be less than the face value. original value of the share.
Suppose the share value is 10 rupees, then the price has to be more than, either the same or more. It can't be less than the face value of the shares. Okay.
Yes. If the issuer doesn't declare the price band early, they must announce it at least one working day before bidding starts using the same newspapers where the initial ad was published.
So, we'll soon understand the company need to give an advertisement. Okay. So one advertisement is called the pre-advertisement, another is called the post-advertisement. Pre means before the issue starts, and second, that means once the issue is complete, then the company has to make a final advertisement. Okay. So the company has to advertise all this in the newspapers, so that they have to announce the issue band just one day before, at least one day before the bidding starts. If they have not mentioned this in the red herring prospectus, they can do so one day before the bidding starts. Okay, read this.
What must be included in this announcement? Key financial ratios like EPS, PE ratio for both the lowest and highest price in the band, a note directing investors to the section in the document that explains how the issue price was decided. Where this info goes, the stock exchanges websites, application forms online that investors use.
So that means the company needs to give all their ratios like earning per share, how much EPS they've been making, what is the PE ratio. In case if there is a price band, they have to calculate the PE ratio for both the lowest and the highest price band, and we will soon understand this through an example. Okay, and they have to give a justification in their document, how the price has been arrived, and explain how this issue price was decided. So this is very interesting. So we'll understand that. Okay, pricing. ये तो हो गया एक second. So this is the same thing I just again said. Okay, differential pricing. Differential pricing को छोड़ देते हैं, बाद में आते हैं. हाँ, अब आओ.
Price and price band.
So basically, company have to declare a price or price band. Price in case if it's a fixed issue, a price band if it is a book built issue. And finally, the final price which has been arrived through the book built mechanism, that must be, written in the prospectus and registered with the register of companies. Okay. In the register of company, the price will be only one. Okay. Now coupon rate, just forget it. We can discuss that later. Okay. Read this.
The band early price.
So that will be 120%. Okay. So if the lower is 100, then the upper and maximum can be 120. Okay. So then just read this. Now, once the company has declared the price band and the issue is open, okay. Now, if the company is receiving a lot of good response, so company may think that the price band needs to be upwardly revised, because maybe that they have done a mistake, so they can do so. Okay, they can revise the price band by 20%. And the second case, if they find that nobody is applying at the price, so they can lower the price band also. So they can make a revision, either upward revision in case if the response is very high. So they can do it immediately on the first, second day, because if the offer is open for 10 days, they can wait till some days and announce a revision. Okay. Or they can do either a downward revision or an upward revision, depending upon what is the response of the offer. So let's understand this through example. Read this.
Suppose a company initially sets a price band.
Okay, so that means now what will the price it look like? Okay, okay. So this, Kriti, tell me when this will happen. When the response is very good, or when the response was very lukewarm. All right. Then it's very good. So people are making a lot of this thing. So company would like to increase the price of the IPO band so that they can get more applications at a better price. Okay. Scenario two.
Scenario two, decrease the float plan.
So then in this case, when it will do, when the response was very poor or it was good. Okay. Third. Okay. Okay. Last. So I am also, I was thinking, okay, so we'll come back to this. Okay, let me just apply my mind. I'll tell you that. Go the last window.
The chosen region should be
So whenever the revision is made, then the issue, time will be, increased by 3 days. The chosen revision should be announced publicly, and the bidding period may be extended up to 3 days if any revision is made. So whenever there is a revision, so the total period can be revised for next another 3 days. Okay, if suppose the total period is for 10 days, it can go up to 13 days, for example. Okay.
the floor price of the capital price. So,
So we have done that. Suppose the share price is 10 rupees share price. So the price, the final price cannot be below 10 rupees. Okay. That's the face value of the share. Okay. Okay. Read. Now, as I told you that, that company has to make a pre-issue advertisement. Okay. So, and also a post-issue advertisement. So that we'll discuss at the end of this thing. So if the issuer has not given the price band, okay, in the red herrings prospectus, it can do so at least 2 days before the IPO opens. And if it is an FPO, at least 1 day before the FPO opens. Okay. Now,
the announcement will not can also contain only the financial ratios.
okay, hold on. Now, whenever you read a prospectus, I'll ask you to go through a prospectus of any company. So you will find there is a section where the price and the price band section is there, where they give all the ratios. Okay, so I made a case study which I'm going to discuss right now. It's a small case study. So where they have to give a justification, why the price was fixed, what is the basis for issue of the price. Okay. Okay, read the second one.
The announcement and the relevant financial ratios can be disclosed under the description of the stock exchange operator yes, which are also in the elimination price within the website of the service.
Okay, so we'll understand this, application forms later on. I'll show you that. Okay. So okay, ये तो हो गया, ये भी कर लिया, दोबारा आ गया सर. Okay, key concepts explain. Okay, just read this.
Key concepts.
Okay, so let's understand this more. Okay, so now we will go to the basically a case study straight away. Yeah, here's the case study. Just before that, read this.
Basis of issue.
So, I'll advise, I'll show you also, one of the, I mean, prospectus where this all information is given. It gives you the full justification, it gives you the comparison and growth prospects of the company, the P ratio of the company and the industry. It will fully justify, how the price has been worked out. Okay. So this is a special part of the document which I'll be showing it, but let me just show this through a case study. Okay.
Hypothetical case study.
Okay. So now in this case, the net profit of the company is 100 crores and the total number of shares outstanding is 10 crores. So that means earning per share is 10 rupees. Now, since the company is planning to have a upper band of 400, lower band of 400 and upper band of 480, so we'll calculate the P ratio both for lower band as well as for upper band. For lower band, it will come to 400 divided by 10, which is the EPS. So it gives you 40. Okay. So the P ratio will be between 40 and 48. Is that clear?
Yes, sir.
So now it is saying that the price band is going to be between 40 to 48. Okay.
The PEHR tax emissions.
Okay, now let's understand a little bit, and then we'll talk about the POE later on. This thing, P ratio. Okay.
Third, return on equity.
Okay, so now let's see. Now, if you find that the technology sector P is 45 and the company has fixed a price band in such a way that the lower end the P ratio is 40 and upper band is 48, so it is somewhere, the P ratio industry is somewhere in the between. Okay, fine. The P ratio industry is 45, where the company has given a price band where the P ratio will be somewhere between 40 and 48 after the issue price is finalized. Okay. So, okay, read this.
Financial performance to growth potential.
Now, if suppose the ROE of the industry is 15% and this company ROE is 20%, so that means it is generating more ROE compared to the industry. So even if the price, upper band is 48, it can still justify because the company has a higher profitability among the industry. Okay, so this can justify the price of P higher upper band of 40 in case if the price is fixed at say in such a way that the P would be say 48 what was the price between 400 to 480. Suppose it happens to be 480, so then in that case the P ratio will turn out to be 48. So it's okay because the P ratio of the industry is 45. So because the company is having a ROE of 20%, which is higher than the industry. Okay, next.
Market conditions and demand protection. With
Now, because this company is in such an industry which is basically rapidly increasing, okay, and it is well positioned for growth. The company is earning very good ROE, okay. So the IPO band is set to attract investors by aligning it with the favorable market conditions.
risk factors and financial savings. The company's low ratio of funding increase financial savings and low levels of debt, reducing risk of risks.
So that means that two important growth parameters which are in favor of the company or the financial ratios. What are those, Akriti? What are those financial? Both are low, okay, because sorry, RO is high compared to the industry, and company has a lower debt equity ratio. So even if the price is slightly higher, it can justify, and definitely because it is present in industry which is witnessing a good growth in India. So because of the rapid digitalization, So the company can always justify the price between 400 to 480. Now, this is how we justify a price in an IPO. Okay.
This information will be included in the
So all this information will be given in the prospectus, including the justification which we have just seen in the case study, so that the investors can, make a informed decision. Okay, so I'm just going now. This was a case of an LIC. I just try to put this data basis for offer price, though it is not so visible. So it is giving, if you look at, the qualitative factors of the company and the EPS, how much EPS is earned, what is the P ratio, higher the upper band, the lower band, industry P ratio is also given at the bottom. Okay, so I'll just give you, a prospectus, or you can just, we can just search a prospectus. I'll give you the site from where you can download all these prospectus and go through all these details. But I'm just skipping at the moment. Okay, so okay, I'm just skipping to the last one. Okay, now just before we skip, so the promoters have to how much money the promoters have to bring? At least 20%. Uh, just read this.
promoters.
So that means whenever there's an IPO, the promoters should hold at least 20% of the post-issue capital. Okay. If they are not able, then the money has to be refunded back to the investors. So promoters should have at least 20% of the post-issue size of the capital. Suppose after the issue has been done, suppose the issue capital is 100, then at least 20 crores should be of the promoters. Okay, fine. So I'm just skipping that. Other things. Uh, Okay, so now I told you that minimum offer to the public. So just lead the second box. The minimum offer to the public at least 25% if the post-issue capital is less than 1600 crores. If the company has a post-issue capital of 1600 crores or less, then at least 25% should be held by public. Okay. Now, in case if the issue size or post-issue size is more than 1600 crores and less than 4000 crores, then minimum public participation should be at least 400 crores. So 400 crore shares should be with the public if the issue capital is between 1600 to 4000 crores. I'm just running through this. So if the issue size is more than 4000 crores, okay, then at least public should hold 10% of the company shares. So now what happens is that in India, most of the companies have 90% of the company falls under the first bracket, where at least 25% share should be held by public. Okay. So the law says that in a company, at least, 25% of the shares should be with the public. Okay. Fine. Okay. Just read this. All the norm such as, so as was missing here. So this is, under the regulation 6.1. So if you see 6 के साथ asterisk mark है. So that means if the company has met all the norms of net worth, operating profit, etc., in that case, the company should offer at least 35% shares to the individual investors, not less than 35%. So that means 35% or more can be offered to RIs in case if the company has met all the financial criteria, not less than 15% to the NIIs, not more than 50% to the QIBs. And out of QIBs, 5% should be given to the mutual funds. Okay. Now, in case if the company has not meeting the norms, that means company is not having net worth. Okay. Just read this.
Error issue
So there are two important things. This is the first one where the company is not meeting the criteria. So maximum 75% should be given to read the C part, not less than 75% to QIBs. Okay. Only 10%, even less than 10%, not more than 10% will be given to RIs. That means retail individual investors. And 15%, not more than 15% to NIIs. Okay. So, but if the company is profitable and companies, this should be the criteria. Okay. Now, let me just show you this chart. Okay. Okay. Just read this, chart.
comparison of allocation
Okay, regulation 6.1 means that the company is profitable. Okay, 6.2 is when the company is not meeting the criteria. So 6.1 is when the company is meeting all the financial criteria of having, net worth, operational profit, whatever. And 6.2 company is not meeting the criteria. Now read this.
book building
So that means if the company is profitable, then the retail investor should be given either 35% or more than 35% of the issue should belong to the retail investors. Okay. Okay, let me explain that. If the company is profitable, okay, meeting all the norms, then company can offer 35% or more to the retail individual investors. And to NIIs, that means HNIs, it can offer 15% or more. The qualified institutional buyer should hold less than or equal to 50%, and 5% should be held by mutual funds. And out of this QIB, 60% can be given to an anchor investors within the QIB route. Now, the second one, in case if the company is coming under regulation 6.2, when the company is not profitable, then straight away go to QIB. 75% should be given or more should be given to the QIBs. If they have subscribed for 75% or more, then the retail investor should be given less than 10% or equal to 10%. And NIIs can be given less than 15%. Okay. And now the third one, which is called the fixed price issue. Now, if the company is choosing, company has a choice either a fixed price or book building regulation number 6.1. So company can choose either 6.1 or fixed price. Now in fixed price, read this. What is fixed price?
fixed price issue for articles
So that means if the company is profitable and company doesn't want to take a book building route, then minimum 50% or even higher can be given to RIAs. Non-institutional and other people can be given the other part. So, I mean, the balance can be given to both NIIs and QIBs. Is that clear?
Yes.
ये समझ में आ गया आपको चार्ट? रितेश,
Yes, sir.
Akriti, and Abdul. Okay.
Yes, sir.
Is it clear? So,
Yes.
so this is okay. So now, once you will be doing your, your project, so which I'll explain in the next class when we meet. Okay. So you have to choose a kind of a case study. Okay. And go through, and I told you that case studies we can always, I'll just show you the case study and then we'll finish off and have, presentation of Abdul. Okay. I'll just show you this. There was a site where I mentioned I've given the website, this one. So just open this and open this site. Okay. Now you can just open this site. Okay. Or you can even search for the IPO on a Google. So you will get all the information easily available. Okay. From certain sites like Zerodha and others. So they keep, giving. So I'm just, copying and pasting this. So have you got this site now?
Yes, sir.
So here you will have IPO, okay? IPO, OFS, mutual funds, and all those things are given. So choose IPO, current, past issues, upcoming issues, okay? Like past issues, if you say past issues, okay? So it will either you can search the name by the company or you can say security. You can choose security, okay? And choose, uh, equity here, okay? It's moving slow. And then you can choose all the companies. Okay, you can just choose 6 months criteria and it will give you the list of all the companies. Okay, then after carefully going through the list, you can select any one company. Okay, and understand how the company, read the prospectus, put on a chat GPT, and they'll summarize the prospectus for you. What this company was and why this company is raising money. What was the price band, how the company decided the price, and justification, and ultimately you have to justify the price. So what I'll do, I'll share some of the presentations made in the last time by MBA students so that you can have something what they have done and you can start doing that. Okay, fine. Akriti?
Sir, it will be an individual exercise or a group exercise?
हाँ, अब मैं उसी के लिए आ रहा था. देखो क्या हो सकता है, एक तो